Hello, hello. Welcome back to the channel. Please hit that like button, subscribe, share the video. If you're brand new, welcome to the channel. I appreciate you being here. If you've been here before and you're familiar with my channel, welcome back. I'm going a different direction with my channel. I'm going to be mainly focused on ICT concepts, day trading, and operating this trading thing as a business. So if you're somebody who's interested in learning how to operate as a business owner, as a trader, I'm heavily into that. So everything I do with this, I'm gonna show you, I'm pretty much gonna try to cater to people who want to operate like a business owner as a trader. And you should be doing that anyway. Everything in your life, you should be operating as a business because it only makes sense. So I'm gonna be doing a little of that on my channel, showing people how to do this as a business and showing strategies and techniques and concepts that are revolved around ICT. I started learning ICT back in 2021, so I'm a student from 2021. I was familiar with him prior to that, so about 2019. But right there in 2021, he was offering his last mentorship, and I was able to get in on that. So now I am considered a charter member. So that's when you pretty much graduate to the next level. You pretty much learn the basics from him, and then you graduate to the next level. And then here I am 5 years in. I have not taken a day off. You got life things going on and things try to get in the way, but I make this a priority to learn this skill set. And learning this skill set does take years and it does take time. So I'm just trying to be here as a living testament and walking through the path of somebody that you can follow and see me going through it, because it's not easy at all. This is one of the hardest things I ever had to do. But over time, just like anything, it becomes easier and easier. If you try to go to school to be a doctor, you already know you might have to go to school for 10 years and get $100,000 debt. Anything you do. So anything that's high skilled, it's going to take years to develop. And this is one of the most hardest things I ever had to do. And guess what? It's progress being made every day. So I haven't been doing much on my channel in months. That's because I've been in the lab locked in. I have about 6 months every day. I have a small little mentor group that I've been mentoring, and I have been in there every day with them and also developing my own ability and becoming an operator in this market. So today on this video, we're going to specialize in showing you how you can carve out a check every day in the market. I'm going to simplify it for you. I'm not walking over ICT or none of that. I am ICT student. That's my mentor. So I'm going to be showing you how I interpret his concepts. There's nobody at the moment. If you study ICT, there's nobody greater than ICT. So let's get that. You know, he is the GOAT. So I am the baby GOAT. So I'm just trying to show you how I interpret his trading style. Okay. So here lately, and he's mentioned this in the past, he talks about how to trade every hour, finding trade setups every hour. So this isn't going to come easy, but you should practice. You should practice. It's going to take practice. So if you don't just jump in this and trade live money neither, you're going to have to demo this for months. All right. You're going to have to be a demo trader for months before you can even think about putting live money into the markets. All right. And that's just being transparent. That's how I had to do it. I had to, when I first came to ICT, he said, hey, the first year, no live trading. Guess what? I followed that. I didn't trade for the full year. First year of learning his concepts, I did not trade the first full year. Second year, that's when you can enter the demo account. That's exactly what I did. I entered the demo account year 2. Now that's crazy for a lot of people that want to make money. Maybe it might take you shorter time. Me, I just stayed down to earth and kept grounded because I know the long term. This trading is a long term game. All right, this is a long term game. So this ain't nothing that you're gonna get rich quick overnight. But you can carve out and start. You can start carving out income. You can start replacing bills. Like, you know how you go to work and exchange your time for money? Well, this can replace you going to work and exchanging your time for money slowly over time. And for some people, that's the ultimate goal. For me, that's that's one of the ultimate goals that I had pursued. I said, hey, I could start making a light bill here. I can make a car note there. I can make my mortgage payment here. So yes, you can do that. You can do that plus more than you can ever believe. But in the beginning, you have to start small. You have to think small. So let me get into it. So I've been into this whole thing as trading as a business lately. I have an entity as a trader, so I trade as a business. So every time I make a trade, it has to be a business decision. Uh, Let me give you some framework. Right now I'm on the hourly time frame. I'm looking at the NASDAQ futures. All right, this is the micro. So if you're brand new, I suggest you start in the micros. The minis are for the heavyweights, just more leverage, pretty much. More leverage, more weight. So if you're somebody who got less money, you could trade the micros. But right now, the market environment has been very difficult since the holidays. And right now it's February the 1st, 2025, Sunday, February the 1st, 2025. So first thing I want to do is I want to lay out my weekly dividers. So if you're brand new, I'm on the 1 hour time frame. Now, what I'm about to show you how to find setups every hour, it doesn't require high time frame bias. It does not require to understand what's going on in the higher time frame in the beginning. In the future, once you understand what's going on these lower time frames, then you can understand the higher time frame narrative at play. Daily bias, weekly bias, etc. But just for drills, you want to do this for drills. Like get yourself accustomed to seeing this over and over and over again. So that's the purpose of this. That's the only way you're going to condition yourself to start seeing how the market operates. So right now, this is an hourly time frame. The purpose of me drawing these vertical trend lines on the 1 hour, this divides the weekly ranges. All right. So what do I mean? Each one of these vertical trend lines, I drop them on Sunday at the opening. The opening price on Sunday, if you're looking at the NASDAQ futures. And this applies to all index futures, even the commodities. So typically at 6 p.m. on Sunday, that's when the new week begins. So that's all I'm doing right here. I'm dropping these vertical trend lines to represent. So if you just look at where I have this vertical trend line right here and this one right here, see, we just started a new week. So at the time of this recording, it is 9:13 p.m. Eastern Standard Time. All right. So the market opened at 6 p.m. Sunday. So we got an entire week to trade. So when I'm looking at just this range right here between these two vertical trend lines, this was last week's price action. All right. And then if I just scroll to the left back in time, this was 2 weeks ago, 3 weeks ago, 4 weeks ago, etc. You can go back as far as you want. Right now, a lot of times if we have large ranges, I won't have as many. But right now, the market is been held in a consolidation for like 8-9 weeks. So the purpose of doing this is to see old data behind in price. All right. But I'm only showing you to refine what I'm about to show you. I'm only showing you this so I can refine what I'm about to show you. So next, I'm going to throw up my daily dividers. So let me highlight my daily dividers. Boom. All right. So when I throw my daily dividers up, I'm able to see the opening price for each day. So Monday, Tuesday, Wednesday, Thursday, Friday, we go to Sunday, and then it all over again. Monday, Tuesday, Wednesday, Thursday, Friday. It repeats every day, every week. It does not stop. So I already got that highlighted. So now the purpose of this is I can focus on each individual daily range. So you got Monday's trading, you got Tuesday's trading. You can see the range from low to high. You got Wednesday's trading, high to low, Thursday trading, etc. This is something that repeats. And how do you apply this? You put it on 12 o'clock midnight. So for the daily ranges, you drop the vertical trend line at 12 o'clock a.m. midnight. Make sure that your charts are set to New York Eastern Standard Time. That's the time zone that you have to operate in as a trader. Because if you don't know, the markets are algorithmic. They're programmed. They repeat over and over again. There's nothing random about these markets. There is a algorithm. Okay, there is an algorithm. So Let's get that understood. If you don't know, or you're new to hearing that, there's an algorithm that controls these markets, and us as operators, we're here to get in sync with the algorithm and institutional order flow and capital. So that's our whole theme right there. You know, when I first heard that, instant light bulb went off in my head that these markets are rigged, they're algorithmic. So if they're algorithmic, how can we better understand the algorithm? So that's my point. So, okay, that's how I frame this up. So you got to have framework, all right? You got to have some type of framework. Framework first starts with ranges. So you pretty much want to find two points of reference, which would be a swing high or a swing low reference points. So for example, I'm going to zoom in a little bit. All right, I'm zooming in a little bit. Let's find a reference point. Do you see this swing high right here? And I'll go into that at a later time, but you got a swing high. This was Thursday of last week. It's currently Sunday, so we just began a new week. This was Thursday of last week. You got this swing high right here down to this swing low. Those are two reference points, all right? Now, I'm just giving you context. You have to frame, before you even enter a trade, you have to have some type of framework to determine if the market is in a premium or discount. All right, you need to determine first, are we at a premium market or are we at a discount market based on the time frame that you're looking at. So because I'm on an hourly, I'm going to drop a vertical, I'm going to drop my Fibonacci from this high right here down to this low right here, all right? Let me show you again. This high right here down to this low right here. That's my reference point. So when I do this, I use my Fibonacci to divide that range from high to low into a premium market and a discount market. So if you don't know, you want to be a seller in premium market conditions and you want to be a buyer at discount market conditions. So depending on the higher time frame order flow, the monthly, weekly, and daily, that's going to give you more indication on what direction price wants to draw to. I'm not doing that here. I'm just giving you context on if you see this market right here, how it went to a premium. So let me give you more. The midpoint of this range, above it is premium. The midpoint represents equilibrium, which is fair value. So anything above the midpoint range of that right there is premium. Anything below it is a discount. As you can see, when this market dropped down lower, okay, it displaced lower. It ran lower. It was a sell-off day on Thursday. Large range day too. After it sold off, that range traded back, that low, price, after it dropped down this low right here, price traded back inside this range to offer what? Premium above the 50% level. If I had to give you some color to it, let's give some color to it. Above the 50% level, I'm going to give it a, let's say, blue color. I'm going to give it a blue color. All right. And below the 50% level is going to represent discount. I'm going to give it a red color. So above in the blue is premium. Below in the red is discount. All right. I'm going to type it out for you. Above the 50% level is premium. Below the 50% level is discount. All right, you see that? So now we have determined a dealing range. Now, this is all back testing. This is all hindsight, all right? But in order to get better and learn this skill, you got to do a lot of this right here. You got to do a whole lot of this so you can see old moves and old price data. Now, imagine only seeing, if I scroll my screen over here to the right, to the left, I mean, imagine watching price real time and you don't know what the next candle will do. Well, you kind of have to forecast and predict the market. And that's pretty much what I'm showing you how to do with finding a range and determining if it's a premium or discount. And then in other concepts, understanding higher time frame order flow. All right. But we're not done. This is just a higher time frame dealing range. Now, let's go to the 1 minute time frame. A lot of people are like, oh, the 1 minute. A lot of people like the 1 minute. A lot of people hate the 1 minute. It's too fast for them. So, if this is something crazy to you, then it might take some used to getting to. It might take time to get used to. All right. So there's specific times of the day. All right. There's specific times of the day that the market has high volume. I'm sure a lot of y'all already know that are under ICT. And if you're brand new, I'm about to teach them to you. So there are specific times of the day. You got the London session. You got the New York session. For me, those are my two primary markets. I'm primarily a New York session trader, but I will make exceptions sometime for London if I'm up for it. But I do have to get rest. You got to have balance. I feel like if you're brand new, you got to pick one. You know what I'm saying? Pick one and stick to it. Don't trade outside of your session that you choose to trade, because you're just opening yourself up to more. You just open yourself up more to the possibilities of losing. So always pick one session when you're brand new. All right. Pick one session. All right. So I'm going to highlight the London kill zone. So the London kill zone starts at 2 a.m. So you see this vertical trend line right here? That represents 12 o'clock midnight. So at 12 o'clock midnight, the new day starts for Thursday, for this particular day, and that each day going forward. I'm going to find 2 a.m. and I'm going to drop a vertical trend line on that. 2 a.m. Boom, right there. 2 o'clock in the morning. That begins London. All right. I'm going to drop a vertical trend line. So from 2 a.m. to 5 a.m. 2 a.m. to 5 a.m. That is the London kill zone. Right there. All right. All right. Next, I want to go inside of this. All right. Now, just like I just showed you on the 1 hour, all right? Just like I showed you on the 1 hour time frame, there are ranges on these lower time frames that if you want to carve out a daily check or some income every day, you should know what they are. You know what I'm saying? You should find these ranges on these intraday time frames. So, for example, once 2 a.m. starts, a lot of volume comes into the market because that's a time where Asia and the European sessions begin, and there's a lot of volume that comes into the market during these hours, right? So prior to 2 a.m., you got an opening range at 1:30. You got an opening range at 1:30. So that's something more advanced. I'll go into that at another time. So 1:30 starts the opening range, right? And let me do this right quick. And if you're brand new, please hit that like button, subscribe to the channel. If this is like giving you some insight, if I'm doing a good job explaining this, give me some feedback in the comments. All right. So I'm just trying to teach people the way that I see it. Right. So let me do this 1 second. I'm looking for ranges. I'm looking for another range. So watch this. I'm going to go out to the 15-minute. Before I do that, I'm going to go out to the 15-minute. So on the 15-minute time frame, remember I found the hourly range? Well, on the 15-minute time frame, prior to midnight, all right, we had a range. You see this high right here? This swing high right here. This formed at the market open on Wednesday. So there's a closing hour around 5 o'clock, and then it reopens at 6. All right. So do you see this swing high right there to this swing low right there? That's a dealing range. So let me show you what that looks like. I'm going to drop a Fibonacci from this high down to that low. All right. Boom, right there. So what I just did was I divided the range from premium to discount. We have a dealing range. So when the market dropped down at the opening, because this is going to give me more context when I drop down the lower time frames. So once we drop down right here and we rallied back up in this retracement, price crossed over into midnight and it consolidated right before the opening range for London session. All right. So after that, I want to drop down to a 5-minute. And on the 5 minute time frame, I want to see if I can find any type of ranges. Now, there's all kind of ranges happening. But we're still in this range right here, this Asia range. So I'm gonna call this the Asia range right there. That's the Asia range. We retrace up, going to premium, and over here to the left. All right, over here to the left. That's what I was looking for. There's some reference points. There's some institutional reference points that we can highlight. So we got this. What is this right here? This is a fair value gap in the form of a SIBI, which is a sell side imbalance, buy side inefficiency. I'm going to highlight that right there. That's a 5 minute SIBI right there. All right. Key reference point. So as price rallies up into the premium, and you got to understand where you are in the range. You got to understand. When we rally up into a premium, price trades right into that fair value gap and it starts to consolidate. Now, I will admit this price action right here on this particular day was not clean. This was not clean at all. This is a high resistance condition because of the back and forth in the overlapping of candles. This is a high resistance market condition. But I want to show you that there's still opportunity. Let me hide this right quick. Now I'm going to keep that on my chart. I'm trying to determine, keep this or remove it. I'm going to remove it off my chart. All right, I'm going to remove it. Because all I was doing with that blue shaded area was showing you that we are in an hourly premium. So, understand we are in premiums. So smart money is going to want to find shorts, pair their shorts to go. They're going to want to offload their long positions to go short. So we're in the premium market. We cross over into the opening range during London. This market condition right here is high resistance and low probability. But that doesn't mean there's not opportunities. So let's drop down to the 1 minute time frame. All right. Drop down to the 1 minute time frame. Now on the 1 minute time frame, price leaves behind minor liquidity pools. All right. Minor liquidity pools. Now, you see this swing high right here? This is a minor liquidity pool that you can reference. So I'm going to highlight this right here. This is buy side liquidity right there. All right. Buy side liquidity. Now, this high right here down to this low right there, that's a price range. All right. This pink or red shaded area is a 5 minute SIBI on the higher time frame. So on the 5 minute time frame, it shows price rallying into this level and then kind of rejecting and falling lower. But then it comes back inside of it. Again, this is not clean, but still tradable. So let me draw a Fibonacci from this high right here down to this low right here. So you need to find two reference points to frame up a trade that can repeat over and over again every day. All right, two reference points. So this swing high to this swing low, we find a dealing range. Not all ranges are going to be equal. Some of them are going to be clean. Some of them are going to be high resistance. High to low, all right. That's your dealing range. So whenever we trade up into this level, price displaces lower in the opening range, 1:30 a.m. to 2 a.m., drops lower. What did price key off of? If you look over here to the left, we have, look at this area right here. This is a volume imbalance plus fair value gap. So you want to reference that. This is a inversion fair value gap right here. This is an inversion fair value gap. So when price drops down, it trades down into an inversion fair value gap. So how do I determine it? Let me show y'all right quick. There's a gap in price right here that the bodies don't overlap, only the wicks. You see that? This is called a volume imbalance. But whenever you have this volume imbalance and this down here, this wick, you got to include both of them, and that becomes an inversion fair value gap. All right. We trade back up through it. You can see our price, this candle right here, it drops down into it and fills the volume imbalance. Plus, it fills this little inefficiency right here. And then it rallies up into that 5 minute SIBI, and then it creates a swing high, which is our reference point for the dealer range. and then it breaks down, comes right back down into the what volume imbalance. I mean the inversion fair value gap. Now, when it trades down into the volume inversion fair value gap, it displaces higher. All right, it displaces higher, and it goes into the premium side of the dealing range. So now we got a dealing range from high to low. It goes into the premium. Now, let's show you some entry techniques. So when it finds support here, and I'm going to remove this right here and only focus on the current dealing range that I'm highlighting. Once it finds support, it initially shows some reversal potential by displacing higher. It leaves behind something called a suspension block. So what do I mean? What do I mean, a suspension block? Let me highlight it. You got a volume imbalance right here. You see that? Two candles that the bodies don't overlap. They leave I'm ignoring the wicks, and I see that this body doesn't overlap with this body. You see these candles right here? You see how these bodies overlap? Well, these bodies of these candles don't overlap, which creates a inefficiency in price. And then we got one right down here. So whenever you see this, a candle right here, this singular candle, anytime that it has a volume imbalance above it and a volume imbalance below it, you combine the whole entire gap, and that is called a suspension gap. So once price drops down and finds support, it displaces higher, and guess what? What does price do? It returns right back down into it right here. Boom. Guess what that is? That's an entry opportunity. That's your ability right there to find not long runs, but potential trades. All right. So let's measure that. Let's measure the top of the fair value gap right here. Let's say you place a limit order right there at that position right here and ride this price up. Well, guess what? How far did it go? Let me show you. Place an entry right here and then ride it up. And you want to look for inefficiencies or liquidity. So you want to look for old highs or inefficiency. Where does it trade to? Look at this area right here. What is this called right here? That's a SIBI, sell side imbalance, buy side inefficiency right here. I'm going to highlight that. So you could took a scalp for about, let's measure. Entry, exit right there. Let's say about 12 points. Now, if that was a mini contract, if that was a mini NASDAQ contract, which would be $20 per point, 20 times 12, that's $240 right there. That's $240 just from this entry right there for 12 points, 12 and a half points, give or take. All right. That's all you need right there to carve out potential profits. Right. All right. And guess what? This is going against order flow. Like, there's no clean price action. You see all the back and forth in here? Not clean at all. And the overall order flow for this particular day was bearish. So whenever you're going against order flow, you want to find low risk entries, not over leveraging. So for example, if you're bearish on a higher time frame, you can, whenever you look for shorts, you want to put on your max entries. Whenever you want to go against order flow, you only want to put on minimum entries, so one contract. So imagine putting on one contract right here, getting out right there, $250 if that was a mini. If that was a micro, that would be, let me see. If that was a micro, that would be $24, right? So if that was a micro, that would be $24. Now, let's see how long did that take. So let's say you had to pay yourself an hourly rate. So, okay, 1 o'clock began, right? 1 o'clock began, you didn't trade yet. So price trades down into this level right here, and you get out right there. How long did that take? That trade took about 4 minutes. So you essentially made $24 if you're trading micros. If you was trading micros, you made $24 in 4 minutes, right? $24 in 4 minutes. That's not bad, right? A lot of people don't make $24 in an hour. So imagine going ahead and scalping $24 in 4 minutes and then resetting and waiting for the next setup. Now, if you're trading minis, that's $240 per minute. Excuse me, $240 for 4 minutes. Put that in perspective. All right. So that type of entry right there is all you need. From entry, exit, done. Now you wait. Now you look back, you zoom out. Are we still in the range? Are we still in the range? Yes. We're on the premium side of the range. So imagine getting out right here and actually shorting it from there. Now, this is, let me show you right quick. Let me show you. You could actually short this as well. So once it goes up into the premium, let's drop down to a 15-second time frame. Let's drop down to a 15-second time frame. Let's zoom right back in. So you can see how price rallied into your take profit level on the premium side of the market. And then what does price do? Price immediately breaks down and it goes back down to the discount side. And once it takes out this little low right here, see the rally up? Smart money offloading their longs at premiums, hit a key level. You see weakness in this displacement right here, and it drops back down below this swing low right here. And then it rallies back up into this 1 minute SIBI that we highlighted. Okay, it rallies back up. When it rallies backs into the range right there, you can put a sell limit order right there and scalp it back down. All right, you can scalp it back down. But we're still inside the range. We're still inside the range. So if you want to be patient, you let it play out. You just reset. You let it play out, and then you see price eventually sell off. And then what does it do? It takes out this low right here. See this low? Sell side liquidity. Underneath that is sell orders. Smart money looking to accumulate to go long off of that low right there. You see that? When they accumulate to go long, go out to the 1 minute. You always want to reset the ranges that you're in. You always want to find the new range that you're in. You always want to find the new dealing range that you're in. So after we take out this low right here, price displaces higher, right? It displaces higher and takes out this high. We create a new range from this low to that high right there. That's a new range that we're operating in. All right, that's a new range. So let's say you're only looking for shorts. Well, guess what? It rallies up. It sweeps this liquidity right here, takes out the buy side. All right, once it takes out the buy side, it starts to show weakness and displace. You see this candle right here? It displaces lower, just like that. As soon as it starts to displace lower, you look right here. You see this imbalance? There's a fair value gap plus a volume imbalance. Let's highlight that. Fair value gap, volume imbalance right there. That's another, because what happened? When it displaced lower after taking out liquidity, it swept these lows, which is a signal of a market structure shift, right? We break down, we take out all these lows, we shift market structure. We rally back up. We are inside of a new range. So we're in the premium side of the new range. See this Fibonacci low to high? That's the new range. All right. You're operating inside of that range. So you want to be a short seller at premium. So you see how price rallies back into this fair value gap? That's your entry technique right there. All right. Let's say we enter right there and price displaces low. What are we aiming for? Opposing liquidity or inefficiency. So what does it do? It drops right back down. Boom, takes out that low. 37-point run, I would estimate 40 point run, all right? So again, we are inside this session from 2 to 5 a.m. We already took one trade, all right? I already give you the numbers on that. Well, guess what? We're inside of the 2 o'clock hour, and here's another trading opportunity. So this is hour 2, 2 o'clock in the morning. High frequency trading, understanding the ranges, etc. So we enter up here, price sells off, takes out the liquidity for 40 points. Let's give you some math. So if you was trading a mini contract, it'll be 20 times 40. That's an $800 run just like that. So let's say you made 240 right here on this price move with a mini, and then you find another in the second hour, hour two, and find a 40-point run in the mini. So that's 800 times 240, or plus, excuse me, 800 plus 240. That's $1,000 and 40. That's $1,040 just like that. All right, $1,040 just like that, and you only traded 2 hours. At that point, you can be done. You could be done for the day. You could just be done and not even trade New York. You don't have to trade anything else. All right, but let's keep going. Let's just give you more examples. So after we take out this low, right? We take out this external range liquidity. That's what it's called. We didn't just take out that low. We took out relative equal lows. So these low right here, you see that? These relatively equal lows. We create a new range. What's the new range? From this low to this high. So all I'm going to do is I'm going to drag this down right there. And we got a new range. We got a new dealing range. Take out sell side. And now we're operating in a new range. So what does price do? Takes out liquidity. It displaces higher. Displacement means rapid movement in the opposite direction. It moves rapidly up. All right, it moves rapidly up. Let's drop down to a 15 second to see if we can see something cleaner. Because you frame it up on like a 15-minute, 1 minute, 5 minute. You can frame your setups on the higher time frame. You got to know where you are on the higher time frame to do this. But once you frame everything up and understand where you are on the higher time frame, you can easily understand what price is trying to do. But we take out this sell side liquidity right here. We displace higher. I don't like none of this in here. All right, I don't like none of that price action. But let's say you had to get in there. All right, this is all muddy in here. But again, here goes a fair value entry right there because we displacement. When we displace higher right here, what are we doing? We're taking out these highs. That's your signal that price potentially wants to move higher. So look at the displacement up after taking out liquidity. Take out liquidity, we displace higher, we liquidate these highs, and then we retrace back down. And when we retrace back down, we trade into a fair value gap volume imbalance right there. All right. So we trade back down into it. Yes, it trades through it. And this potentially could have been the one that you get stopped out on, but that's the risk you take. You know, you're just waiting. I think it's a calculated risk. You know, it's not impulsive. You're just keying off of certain mechanics of the market. You put your stop loss right here. So you got the fair value gap and your stop loss will go right here. Does it come down and take your stop loss? No, it does. It doesn't. Price instantly rallies up. All right, it rallies up and we're on the discount side of that range. And when it rallies up, let's say you enter right here where this fair value gap entry is. You don't want to hold on to these trades for long at all. You don't want to hold on to these trades. Let's say you enter right here, midpoint of the gap, and you exit right here for 12 points, or you exit right here for 22 points. Now, when you're brand new, only run one contract. But eventually, when you grow into this, you can start adding more contracts, which don't never over leverage. Stay within your risk framework, 1%, 2%, whatever it is. But imagine dropping down in here and then rallying up, taking profit right there, 22 points. So you could have pulled a partial right here, pulled a partial right there. You see these relative equal highs right here. You could have pulled a partial. This level right here is a 1 minute SIBI. You could have pulled a partial right there. Or you can hold for liquidity. All right. So once price rallies up and takes out liquidity, it creates a new price range, which that high right there is that 1 hour. Let me show you. Go back out to the 1 hour. That high that I just showed you that we just took out right there, that created the 1 hour range because we consolidated and then we went over into New York and you can see what the price did. But the whole point of this teaching is you don't need, you don't need to do, you don't have to use higher time frames. You don't need long price runs. I'm showing you a model that repeats on all time frames, and you can find consistent setups working between the 1 minute, the 5 minute, and the 15-second time frame. That's the whole point of this. How do you start it off? You find swing points, reference points. That's the first foundation of it. What range are we currently in? What's the current dealing range? All right. So from this range right here to that high, takes out liquidity, it creates a new range. Once we take out that liquidity, the new range would be right here. And let me hide this right quick. I'm gonna hide that. So the new range will be from this swing low right here up to this swing high. That's the new range. We're in the premium side of it. Let me remove some of this. Remove this, clean it up a little bit. I hate to have messy charts, but I'm trying to illustrate for you. So the new range is from this swing low to this swing high. And you can see our price trades down, it consolidates or retraces. It goes down to the midpoint, which is equilibrium. It goes below it, discount. So you could have took a short scalp from there to there. And then it rallies back up, consolidates, drop down to discount again. So and then it consolidates and it shows weakness, drops all the way back down to discount, and then it rallies up. So it starts to become a little bit more difficult. But eventually, what does it want to target? That's my point. Eventually, what does it want to target? And that aligns with the higher time frame narrative of this day. Because it eventually, near the end of the session, starts to roll over to attack the sell side where there are relatively equal lows at. That's a key thing. So you see these lows in here? Look to the left. See these lows? They're going to want to attack that to grab the liquidity for longer price runs. So that's an example of that. I don't want to make this too long-winded. I'm just showing you how there are high frequency setups every hour. Like I said in the beginning, you don't want to use live money doing this. You just want to simply practice. So let me run it back to you one more time. You want to find swing points. So start it off like this. Go down to a 5 minute or 1 minute. Find swing high, swing lows. And when you do that, you use them as reference points to say, hey, this is the current range that we're in. And watch how price trades between both sides. And when all price is doing is aiming for liquidity or inefficiency at a premium or a discount. Once it takes out liquidity or aims for it hits a premium level or a discount level for inefficiency or liquidity, then that's when you get your reversals or your entries, etc. You want to find where there are equal highs and lows as well. So for example, prior to us selling off right here, we had relatively equal lows right here. Price is always going to want to attack the relatively equal highs and lows. The next thing is you want to find a framework. All right, you want to find the framework, high to low. You want to highlight liquidity and inefficiencies. You want to work between a 1 minute, 15-second, and a 5-second. And you're not looking to hold positions long at all. You're trying to get out at, again, liquidity, inefficiencies, and taking profits and paying yourself. A few of these, like not even the minis. If you're trading a few micros and you're trying to look for like an hourly salary, this can be the hourly salary. There's many setups in here. So for example, watch this. For example, this range that I currently have highlighted, this high to this low. We rally back inside the range. We go to the premium side. It rallies. You might think it might want to come up and take out the buy side liquidity right here. But no, what is it doing? It's taking out minor liquidity right there, minor liquidity. So you have that highlighted on your chart on the premium side. It sweeps it. Now let's drop down to a 15-second. Drop down to a 15-second. All right. Trading inside the range. Very important. Very important. Understanding time as well. This isn't going to happen. Don't expect consistency every day. If you're looking at this price action right here, I'm showing you difficult conditions in this particular price action, but it's still tradable. So that's my point. But when we trade up into this level right here, we sweep the high. Okay, that's a smart money reversal entry. A lot of people are not going to be able to enter off of that. A lot of people aren't going to be able to trade that. So it trades into that high and then it breaks down. Look to the left right here. What is this right here? That's a BISI, right? Buy side imbalance, sell side inefficiency. But what does that become if we trade through it and return back into it? Well, that becomes an inversion fair value gap. So let me highlight it. Inversion fair value gap right there. All right. Drag it out to the right. So price trades down into this. If you drop below a 5 second, you can see there's more refined entries inside of these candles. We would drop down, we return right back into it. Is that random or is that algorithmic? How this candle right here trades right back into it, that's not random, all right? And it touches the 75% level on the premium side of the dealing range. Taps it, sells off. Guess what? You get out right there. How many points would that be? How many points would that be? That's a 9-point run. You might want to hold for longer. If you decide to hold for longer in these conditions right here, well, guess what? It's going to rally back up, touch it again, sell off some more. When it sells off, look at these lows right here. These relatively equal lows. You see that? Let me reference that for you. Relatively equal lows right there. All right. It trades into those relatively equal lows. And it also trades into a SIBI. All right. I'm not going to highlight the SIBI. I'm going to keep it right there for now. But once it sweeps those lows, what does it do? You get a reaction in price. It displaces higher. All right, comes back down. What do I see at the discount side of the market? Now, you want to stick to one side. I wouldn't, if I'm looking for it to go lower, I'm not trying to enter here as a long. But you can see how price, the algorithm refers back to this level. This right here, like I showed y'all earlier, this is an inversion gap. You got a volume imbalance, SIBI, but we inverted it. We traded through it, back into it. It supports it. This candle right here is an order block. It displaces higher, goes back up inside of this inversion gap. When it trades back inside this inversion gap, what does it take out? You see these highs? All right, you see these highs right here? Buy side liquidity. Buy side liquidity. So it takes out those highs, but it's reclaiming this fair value gap. So it's coming back and reclaiming this inversion gap. It displaces lower. It's really consolidating, but if you was to stick to one side, you would have to sit through this. All right, you would have to stick through this, and it's on the premium side, so you eventually know it's going to want to roll over. All right, it's going to eventually roll over. It attacks the sell side, drops down, goes below the discount. All right, you get a reaction in price again because that's the bottom of that 5-minute. What was that, SIBI? Or inversion gap, one of them. It was a 5-minute level. This pink shade area drops to the low, and then it rallies back up one more time. And in the process of it doing that, it created another dealing range, so you can get a swing high to low on the 1 minute, trades back up. So I know it's a lot, but it can be done. It takes a lot of work. This doesn't come overnight, okay? This doesn't come overnight. As you can see, as I drop out to the 1 minute, all of that is consolidation. And then there's something called macros where the market is going to move at specific times. So this sell-off pretty much happened during the macro, which is 450 to 510. That's when the market eventually sold off. Let's say you hypothetically entered. Excuse me. Let's say you entered right here at the premium and dropped it down for the liquidity. Excuse me. That's a 60-point run. And let's say you was trading a mini. So that'd be 20 times 60. That's $1,200. If you're trading a micro, $2 times 60, that's $120. Don't sleep on the micros. Right there, I showed you many setups, and trading micros are forgiving and affordable. So if you're trading micros, I just showed you many setups that can net you pretty much a few $100s. Exchanging this skill set for time that you would put in at a job somewhere. If you were working a job, the goal is to get out of that job and replace it with something that can save you time. You know, if you do this early in the morning, 2 a.m. to 5 a.m., you won't have to go to nobody's job at some point. You know what I'm saying? At some point. So if you're a London trader, if you're a New York trader, same thing applies. I'll cover New York at a later time, but this right here was high frequency trading. Now, let's zoom out right quick. All of this was scalping on the 1 minute. Remember that? All of this was scalping on the 1 minute. I'm showing you multiple ranges, multiple entry techniques, multiple liquidity sweeps from premium to discount on the 1 minute. But all of this during the London session, all this consolidation, when you zoom out to the 15 minute, excuse me. When you zoom out to the 15 minute, all that consolidation, see up here, you see this sideways price action where I was showing you many trading opportunities, 15 points here, 20 points there, 50 points here. All inside this consolidation. That was in the premium side of this 15-minute range. All right. So what was they doing in this 15-minute range? They was accumulating positions up here in the 15-minute range right here. Accumulating positions. It displaces just like on lower time frame. Same thing that's happening on that 1 minute, 15-second time frame is happening on the 1 hour, the 15-minute, the 4 hour, the daily, the weekly. All right. Everything is fractal. So it consolidates, it displaces lower, takes out liquidity, shifting market structure, retraces back inside the range right here. And on this time frame, you're looking for longer runs in price. So there goes a 15-minute SIBI right there. You can see how it trades back into it. Price crossing over into New York session. All right, still in the premium side. Crosses over to New York AM session. It displaces lower. Retraces back up. The 9:30 opening bell. By the time that happens, price sells off for longer price runs. Do you need this? This move right here that you see, this does not happen every day at the current moment in the current market conditions. All right. This move right here, let's say you entered, watch this. Let's say you entered up here at the premium level. Let's say the midpoint of this fair value gap that's in pink. And you called it all the way down to this level right here. Boom. That's a 533 point run. Let's say you had one mini contract on. So that'll be 20 times 533. That's a 10,660 point price move in one day. That does not come every day. You should not expect that. So if you know that's not going to happen every day, then because if you get a taste of this one good time, this type of price move, you're going to expect that every day. All right. You're going to expect moves like this every day. This does not come every day. And one contract for a mini is $10,660. For a mini, that's 2 times 533. That's $1,000. Everybody can use an extra $1,000 in the day, right? So, it's all about perspective and what you have at the current moment. It's all relative. So it doesn't really matter. I don't care about the money. I know that sounds crazy, right? I don't care about the money. I care about the execution. I care about performing under these conditions and finding sweet spots in price action. All right. But if you wanted to be a longer holder and wait for a few hours. So this is the thing. There's people that can make money in this consolidation in minutes. They could go make $10,000 in minutes in this consolidation. Or are you somebody that needs, more patience and want to hold a position for about 3 to 4 hours? So that run right there was about, let me show you. That sell-off on the higher time frame, that was about 7 hours and 41 minutes or 45 minutes. So that's about almost an 8-hour price run right there. All right. So I don't want to be in the market all day. So I want to find my window. So let's say you're a London trader, all right? You're a London trader and you was having difficulty trading this condition right here, this consolidation. Well, if you stick to your rules and say, I'm only trading London, I'm not trading New York, then guess what? You did not have a good day. And then you see this where New York sells off and it performed beautifully. Well, you can't get frustrated with that. You got to come back the next day and trade your session. You can't be all over the place until you can grow into it. You're eventually going to grow into it. But I don't want to be too long with this. I want to do more videos like this, more teachable lessons. Hopefully you enjoyed the video. Please hit that like button, subscribe to the channel, and I will be dropping more videos like this in the future. Appreciate it. See you soon.